Hey, I'm Russ Morgan with Wealth Without Wall Street. This is first time to our channel. Thank you for showing up. Welcome. I want to give you the answer to the question, do insurance companies, life insurance companies, actually steal my cash value? And I've been asked this question many times over the years. I wanted to try to simplify it in an analogy for you. I hope this helps. Let's dive in right now. So here's the example, the comparison, because sometimes we need something that we understand in order to better understand something that we don't, right? Life insurance is confusing to many of us, but houses, something that we all probably own to some degree, we probably get much easier. So I'm going to use a house as our example here. Let me make my screen bigger if that's possible. All right. Sorry about that. All right. So houses, that's something we get. We understand mortgages that go with that. Life insurance is hard, but I'm going to even probably complicate it just a tad bit more by saying I'm not going to talk about a generic life insurance policy. I'm going to talk about a infinite banking concept policy, something that we use specifically as a tool to building up cash before we go buy cash flowing assets, because we're about financial freedom. And that's when your passive income is greater than your monthly expenses. And we use these tools as just for that, just as a tool to get our cash in motion to buy cash flowing assets. If you want to know more about infinite banking, go to wealthwithoutwallstreet.com/infinite-banking. If you really want to get deep, we've got courses on it inside of our community. You can go to wealthwithoutwallstreet.com/IBC101. That will give you a link to get inside of our community. You can hit the course tab and then purchase one of our more in-depth courses that can go all the way down to how do you design a policy specifically for you. All right, houses and infinite banking policies, houses and life insurance policies. Do life insurance companies actually keep my cash value when I die? Here's the example analogy I'm going to give you. Let's just say the house we're going to buy is $400,000. We're going to mortgage it for $400,000. The life insurance policy for the same, I'm just going to say our payments $2,000 a month for the house, $2,000 a month for our life insurance policy. Well, what's the $400,000 value for a life insurance policy? On the surface, it starts out as what's called the face value or the death benefit, meaning you buy it, you die. That's what your heirs would get. Day one, boom, easy, simple, right? Now, we know that when in a house, though, when we have a mortgage, that out of that $2,000, some of it's going to go toward principal, but some of it's going to go toward interest, right? So let's just say early on, $500 a month goes toward principal and $1,500 a month goes to interest. Well, how does it work when I put money into a life insurance policy? Well, if it's specifically designed for cash value, like we do, out of that $2,000, we're going to have probably $1,500 a month going to something called cash value. And then we're going to have the other $500 a month going toward the insurance cost. Okay. Simple. You with me? Perfect. All right. Now let's scroll down and see how this plays out as we go. Right. So the question is, do life insurance companies steal my cash value when I die? Well, if I take us down 5 years, and for simplicity, I want to say that our house is still worth $400,000. And I've been putting this $2,000 a month down. And now my principal payments have been $35,000 has gone to principal over that 60-month period of time. And the same thing has happened over here in my life insurance policy. I don't care what it is. We'll say $35,000, doesn't really matter, right? Well, if I wanted to sell my house in year 5 in this scenario, what would I get? Would I get the 400,000 plus the 35K of principal? Well, of course not, right? I mean, why? No, that's a dumb question, isn't it? Like you would never ask your realtor, wait a second, why didn't I get the extra 35,000 plus the 400 that we sold our house for? Or another way to ask that question is, do the new homeowners get to keep my 35,000? That's a really bad question. You wouldn't ask that because you understand the stupidity in that response or in that question, right? But that's what happens when we don't understand something else, and someone that we trust has told us, well, ooh, life insurance companies steal the cash value. And you're like, ooh, that doesn't sound good. I don't want that. So the same thing would be true here, is if in 5 years, I put $35,000 of cash value in it, and I decide I want to sell it. The insurance company's not going to give me the 400,000. They're not going to give me the 400,000 plus the 35,000. That's not the deal, right? I get access to the cash value. I would walk away with the $35,000 in hand. The insurance company would keep the death benefit and move upon their merry way. But let's keep going further, because the question was, do life insurance companies steal my cash value when I die, not when I sell my policy early? So let's go down just a little bit further here. And I'm going to say, what happens when we're 40 years down the road and that's when we die? So clearly 40 years down the road, we've paid off our house, right? So I'm just going to keep our house at 400,000 so we don't have to convolute all the appreciation, taxes, commissions, all that stuff. Let's just keep it simple. Have no mortgage, right? So I have put at least 400,000 worth of principal payments in the house. I got 400,000, paid the mortgage off, right? Zero liability. I die that day. My estate immediately liquidates, sells the house for the $400,000. What goes to my heirs? Do they get the 400,000 of principal plus the $400,000 of the sale price? They don't. So did the new people get my 400,000? Did they steal it? Well, no, they didn't. Again, I keep over accentuating this bad question, this bad statement, just so you would see the stupidity in how someone looks at it from the other angle, right? So in this scenario, I built up 400,000 in cash value and I die. What do I get? Well, my heirs would get the $400,000 death benefit here. Now, it's not perfect, because actually, unless I was age 121, the policy's more, but I'm just simplifying it here. That was what the deal was. They don't get 800,000, they get the 400,000. That was the deal from the very beginning. That's the way life insurance works. Very similar to how our house mortgage works, right? But I want to show you that this is the question. This is the misinformation that has been constantly put out there by financial entertainers. Here's one of them. This is September the 27th, 2021. Dave Ramsey on what is a whole life insurance. He goes in to talk about what happens when you die. So he says the insurance company gets to keep your money. If your family will get the death benefit, but the life insurance company or the insurance company nabs your cash value. And this is one of the worst reasons. And this is why we always tell you to steer clear of it, because that's bad. You don't want a theft happening under your watch or after you die. Get away, stay away from that. Well, we just proved that that was a really bad idea, right? That was bad information, that it wasn't actually factually based concept. But I want to show you something that I know that Dave Ramsey doesn't understand. Because here's the key, is what really is happening with my life insurance policy. What's happening with the cash value in relationship to the death benefit, and what will my heirs actually get to keep? So I'm going to show you a personal life insurance policy I own. I own over 20. That's right, over 20 whole life insurance policies. This is the oldest one, though. I started this whole concept right at the beginning of 2010. So the very first life insurance policy I bought, when I bought it, my initial death benefit was $885,000. That was the face amount. That was that initial thing that I was talking about at the beginning. But because of the way we designed the life insurance policy for infinite banking purposes, we took some of the profit that the insurance company pays us, which is called a dividend, and we use that dividend to buy what's called additional paid up insurance. You can see right now I have over $482,000 worth of paid up insurance. Now, through the years, I've been building up cash value, which is this $199,000 right here. So if I were to die today, what would happen? Would my family only get the 885,000 face amount? Would the insurance company steal the 199,000? No, my family would get the full death benefit now, which has grown significantly greater than the 199 cash value plus the 885, which would have only been roughly what, $1,085,000. No, they get almost $400,000 more, because that's the way life insurance actually works. When you design an insurance policy this way, not only will the cash value internally be available to you to use if you want to as equity, just same way you have equity in your house, but also if it's used properly, it can actually accentuate the growth of your death benefit. So it continues to appreciate. So that way, when you die, yes, your family will get the death benefit, but they will also get the formulation of those other things, which will be larger than your initial death benefit if set up properly. So I hope this clears it up for you. Hope this is helpful. If it was, and you want to share it with somebody else, we'd love to have you subscribe, hit the bell at the top, and share it with somebody else. Thank you for being on our show.